Whenever I see Dr. Carol Knackley, CEO of Crystal Energy, I think it's Thursday, but it's not. It's Wednesday, and that is also the last day of the week for us because it is an Islamic holiday weekend here in the Middle East, and so we will be off on Thursday and Sunday. Let's kick off, however, with Dr. Carol and welcome her thoughts on all things where the bigger trends are going, Carol. We're seeing now, surprising to an extent, that the Fed will be a follower, not a leader on tightening policy, and the ramifications for that seems to be dollar weakness. Your thoughts, if indeed that turns out to be the case, this tightening cycle that starting ever so incrementally, the US will not be leading?
Good morning, Sean. Good morning, everyone. You know, I'm too got confused yesterday night when I remembered suddenly that I'm due to be with you today, not tomorrow. But it's good to see you again. And I was thinking, what are we going to discuss today? Because the mood currently in oil markets is that, as I saw in the news items that you shared, that everybody's being bullish, betting on $100 and even on $200 a barrel oil. So this kind of sentiment.
Well, that's where LNG is, right? LNG is telling us by oil index, Brent should be $200.
Yeah, but they are not the same markets, right? So they have lots of similarities, but also many differences. And on the economic front here, I am puzzled because when I look at the numbers, I am more concerned. It just looks, if you look at the revisions in the GDP forecast of major economies. I mean, we started with China, we saw its growth decelerating. The same started to be said about the US, though we're waiting for more concrete data to come in. You're talking about the central bank in the US, but also I heard that in Europe, particularly in the UK, they might take earlier steps than other banks in the region, central banks, in terms of tightening their monetary policy and even raising interest rates very soon to avoid this overheating of the economy. So you have on the macro picture, you have more worrying signs about potentially a deceleration of the global economic growth. And yet in oil markets, we see all these price expectations and forecasts as if something is going extremely well. And I'm wondering where that is coming from, because when I look at the demand numbers, oil demand numbers, I don't see this kind of pent-up strong demand that people talked about. On the supply side, yes, we haven't seen much happening outside OPEC Plus, though this might be happening gradually. And again, one of the news items talked about shale, US shale, attracting more interest from banks increasingly, not surprisingly, because of the oil price. So the main card remains in oil markets is OPEC. And I know some people dismiss the issue of the spare capacity, so I had to do some numbers here. When we had some really tight markets, think about the early 2000s, OPEC spare capacity was brought down to less than 1% of global oil supply because oil demand was growing very fast, boosted by the genuine strong growth of the BRIC countries, if you remember, among others. Today, OPEC spare capacity is around 8% of global oil supplies. And as I said, I don't see that genuine strong demand pushing a global demand, economic growth, pushing the oil demand that to justify the prices where we are. So what we have today, I see it, is a mismatch between what is happening on the macro front and what is happening in energy markets. And that could create interesting dynamics in the months ahead and next year, of course.
Let's welcome Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. I kind of giggled a little bit this morning, Mike, when I saw the Reuters headline, the oil markets headline, saying that oil was coming off this morning because China government had indicated intervention in the coal markets, that they wanted to knock the coal price down a few pennies, and that in turn knocked the oil price down a few pennies. Tell me why that's happening and what it means going forward.
Well, that's the key thing that I think we need to understand is how we got here. It started with coal issues in China, kicking over to natural gas and all trickling up into crude oil, potentially issues of switching in Europe and things. And that's the key thing. And I think I really appreciate what Carol said, because I think it's best sometimes we disagree on these kind of programs, but I completely agree. There's a big problem with China. You can't be bullish commodities when you see China cutting its triple R rate and it's potentially peaking. the slack demand. She mentioned shale. I mean, the cost of production in the U.S. is $35 a barrel. It's the lowest we have in our database, and I see the price in the screen at 82. The key thing I want to think about here is I have no reason to dispute the forward curve in crude oil. You see 82 on the front contract. A year from now, WTI is priced closer to 70. And I fully expect that's where we're going. We're going to follow that forward curve. I think the curve's going to be right. And there's a good reason why. Like you mentioned, I mean, coal and natural gas, the world's worst commodity since I've been managing commodities, and I did at S&P to invest in and to track, is natural gas. We're still 1/3 the peak in 2005. So I think what's going to happen by the time we look at this back from the future, a year from now, we're going to see, yes, this was a short-term spike. It's more likely to put in an enduring peak like we did in that 2011 to 14 period. And I'll leave you with this. When people talk about inflation in crude oil, right now, WTI is the same price as it was in September 2007. If it was to just keep up with CPI, it'd be $110 a barrel. And so people talk about inflation in crude oil. This is just a deflationary trend picking up to the upper range. It's more likely to follow what happened in the grains. I love the grains because they're the best indication for short term. Prices came up to the highest levels in 10 years. Incentive to produce, supply came on, and now we're back at the same levels we were 12 years ago. So to me, that's what to expect in crude oil. This is short term, and the follow bond yields are still ticking down in this country.
Let's welcome Bill Spindle from Abu Dhabi, Council on Foreign Relations, International Affairs Fellow in India. Bill, in some ways, Mike is kind of answering the question in that indicating that oil prices are actually cheap compared to the historical reference and other commodities. So inevitably, they will get above $100 a barrel because OPEC is not loosening the taps. Your thoughts?
Yeah, I mean, I agree with both these folks. I think
don't ever do that. You can never.
Well, I know. I'm sorry. I wish you could introduce some tension into your show.
Yeah, well, I will. Don't get me started. Don't get me started. Don't worry.
Maybe we'll find a way. But basically,
you'll be throwing arrows at Carol soon enough. Don't worry.
But yeah, you've got this situation where producers are, particularly OPEC Plus, looking down the road to next year, worried about stagflation, seeing sort of decelerating economies. They're not interested in sort of easing up that market much at the moment because they're worried about a price drop, and they want to err on the side of higher prices now. Meanwhile, you've got governments, politicians, bureaucrats looking with great fear at this coming winter, scrambling to be absolutely sure that under no circumstances are they caught out in supplies. So that's pushing prices up a lot here in the short term, but you do wonder what's going to happen farther down the road.
There was a time, Bill, when OPEC Plus used to be quite concerned about letting prices get ahead of itself, so to speak, particularly for the impact on countries like India and others. On this occasion, they don't seem to be too concerned. Are they right or wrong in that?
Yeah, well, I think that's the thing that's interesting here is that you do wonder whether, going into this Glasgow conference, I suppose I spent a lot of time looking at renewables and all that. And I think, in the short term, of course, that's not going to change the picture much. But going into this Glasgow conference, you do wonder whether the message, once again, is going to be received by big importing countries like India, like China, is, fossil fuels at the end of the day are really risky. And in the long term, we have alternatives, not only alternatives that are on the horizon, but alternatives that are kind of in the here and now. And they're really going to, push that as much and as hard as they can, which is going to change the picture over the medium to long term. In the short term, it doesn't make much difference, but in the longer term, it does. And you wonder whether there isn't a similar dynamic going on as there was in sort of the aughts in the 2010s when OPEC sort of greatly underestimated the capacity of fracking to respond to higher prices, and they created this kind of nightmare for themselves that came around to bite them. And you wonder whether they aren't doing the same thing with renewables now in the kind of longish term.
Carol, just coming back on your 8% of idle capacity in OPEC plus, does it really matter how big a percentage that is if indeed it's not deployed? Because ultimately this market is rising on the perception of tightness, or certainly dislocation and tightness. So OPEC may have extra barrels, but if they're not going to use it, it's like we might as well be still in the reservoir, right? There's 5 billion barrels of oil in the reservoirs all over but more now than 500 billion. So there is tightness because it's not being produced, and that's not going to change.
You're absolutely right, Sean. I mean, of course, it's a figure, but don't forget it also carries some kind of symbolic, if you want, influence on markets, because it's usually seen as a safety cushion. And so when we talk about a tight market, usually when you have some real tight market and nervousness in the market, it's when you have that safety cushion running very thinly. But today it's not the case. Now, of course, it all boils down to what OPEC decides to do with that strong card. And at this moment, I don't see them, revising their plans, because typically, if you look at historically where OPEC kind of decided to open the taps to ease the pressure on prices, is when there were two important things. First of all, political pressure. Now, you might say, yes, there are noises coming from the US. Japan made stronger requests and direct requests from OPEC Plus to put more oil in the market, previously India. But to be honest, the US matters the most. And the US is in a dual conflicting position as the largest oil consumer. It's also the largest oil producer. And don't forget, high oil prices also serves, ironically, their climate agenda, because you want to show the bad side of fossil fuel and you want to give more credibility to greener alternatives. And therefore, of course, the White House will say, you, OPEC, you have to open the taps, which is, in my opinion, rather a hypocrite, because you are calling on another organization which you supported a year ago to be in charge of the market, and now you're calling on them to open the taps, while in your own industry you're not giving the right support or sending the wrong messages to the industry to not to produce or invest enough in expanding capacity. So you have the political pressure, which is there but not quite significant today. And the second one, demand destruction. And demand destruction, unfortunately, when OPEC realizes that, it's usually late. And that's why you tend to have this kind of downward rapid trend in oil prices. It takes time to bring them back to their pre-collapse levels. And demand destruction, at the moment, we don't have quite strong, tangible data. We have some signals, we have some indicators, but we don't have strong signals. So at the moment, I think OPEC might well go for even $100 oil price. Putin said, yes, it could happen. The UAE energy minister said the same. So it could happen as long as you don't have the political pressure and the demand destruction sign. I don't see OPEC deviating from its policy. And then, but remember that there is spare capacity, and therefore this translates to me into a more artificial tight market that we have today than, for example, if you talk about the gas crisis that we are seeing in Europe.
Well, it seems to me that OPEC should not have the responsibility to be the brake on inflation when the Fed are printing money like crazy and everybody else is pumping up every asset class. Why should OPEC suddenly be the responsible one? Mike, speaking of things being pumped up, we saw overnight some disaster in the copper markets in the LME in London. I'm wondering, we're seeing, if you like, these other markets that are pushing up the price of crude as well, to a certain extent, as we referenced in our earlier comment, coal impacting oil price. But we had the copper market on collapse, if you like, a big word to use, but nonetheless, it is in the headlines in the English papers today, after what the headline in the Express at least calls a crazy price changes, the London Metal Exchange emergency. Pretty dramatic headlines in the local newspapers in the UK of what's happening there. Markets are clearly stressed because these are extreme moments. What exactly is the incident in LME, and what are the ramifications, do you think?
Well, the incident in the LME needed to be checked with the incident on the COMEX. I checked copper. It was a backwardation where the futures got a little bit extended versus the cash price. And it's the same thing you're seeing in crude oil, but it reminded me of silver in 2012. It shifted this steep backwardation for about 2 months, and that put in the peak around $50 an ounce. And I fully expect that's happening in copper. And the reason I went over to the COMEX is because the LME has been losing volume and open interest to the COMEX for a while. It's amazing how this has gone in cycles for the last few years. But right now, there's more volume and it trades more sufficiently on a COMEX. And the backwardation was nowhere near the peak, which was around 2010. Right now, it's around 3%. And back there, it got to 20% or 3%. So I think what you're seeing here is short-term supply issues that can lead to longer-term, more enduring peaks in commodities. That cure of higher prices, I mean, Carol touched on it, Bill touched on it. OPEC is going to become this created this nightmare for themselves. Just look at this back from a year from now. I see all the supply is going to come back on. Demand destruction is kicking in. And guess what? It's probably more powerful than it was pre-COVID. And that's when things were just inching up, but crude oil was clearly a bear market then. So to me, this is what we need to look forward to is what we're doing here and now. Carol touched on this, is we just accelerated the process. We gave some demand pull forces for decarbonization, electrification. It takes a little while. In Texas, you can get almost 2.5 the cost of production now, average cost of production. That's not just about bankers throwing money at you. You can sell forward on the curve a year from now and get 2.5 year cost of production. I see it. Most markets are more likely to follow the mighty soybeans. It was up 25% in the year, and now I see it's down 6%. Corn was up 50% in the year, and now it's up 10%. Lumber was up 120%. It's what I fully expect is going to happen in commodities, and this is that short-term bounce that we see. We need to look forward from. So I fully expect we've gone up on the escalator, on the elevator. We're going to go down on the elevator like we did in 2014. That's what I'm really fearful about, because these forces that have crude oil about half the price in the peak are accelerating now. And it's just, we got to get through these short-term blips. And the key thing that's out of the picture for a longer period now is China demand. China's going into a big problem. We predicted this a few years ago, cutting our rate. It trickled down to what's happening in property, and the whole country is just that massive economic miracle slowing down.
I wouldn't rule out China's ability to pump things up, as Arnold Schwarzenegger might say. Bill, going into COP26, as you referenced earlier, the picture has changed quite dramatically. If COP was held 6 months ago, I would have said it felt like there was going to be a transformative moment. It now feels like the air is popping out of it ahead before it even starts, based on this premise that we're witnessing a moment where fossil fuels are having a resurgence of relevance. Suddenly it's shortage everywhere. It's, oh my God, we don't have the windmills yet. Turn the fossil fuels back on. What's the outlook, do you think, for the expectation on COP?
I think, it's going to join a long list of conferences about the climate that are deemed greatly to disastrously disappointing in its headlines. But I think what people, what you have to realize at this point is that governments are not going to lead this process at the end of the day. They're in many ways going to be followers, and I think even more so going forward. This process of decarbonization is going to be driven by the private sector. And you really see that, I think, in one of your headlines. You saw some of the big companies, promising zero emission shipping at some point. Again, at a point long in the future. But my guess is that'll get pulled forward. This process is going to be driven by the private sector, and that's really gaining momentum. So I wouldn't be fooled by the fact that the COP will be disappointing, and in some ways should be disappointing, because, of course, if you measure it against what needs to happen to reach those 1.5 degree targets, it's going to be nowhere even remotely close to that, and nor is the private sector momentum.
Where does a country like India go into COP26, Bill? We're hearing obviously from the oil producing side, from OPEC Plus and whatever, they're trying to pull back the reins of change a bit. A country like India, massive 1.4 billion people, they want every energy source available. They want to consume it, right?
They want every energy source available. Absolutely true. They've got huge, development needs for that. On the other hand, they pay $150, $200 billion a year to import fossil fuel energy, and they would like nothing more than to get out from under that burden. And they're going to push in every way possible. Part of the thing is, under the current constraints of financing, and that you almost can't build these renewables fast enough, and that is going to change over time as the financing does come through. So they'll keep pushing on that. But going into COP, what they want is a commitment from the developing world to finally come through on this $100 billion a year that was promised 10 years ago. And if that's what they're really pushing for. And if they get that, then that provides them the cover to start doing some other things, and the net zero promises and that, which don't, conversation for another day, but don't mean a lot in the Indian context.
Yeah, let's go to the survey question before we get a sort of a view from everybody on where the next few days may go, or as we take a break in the Middle East. It's sort of back to where we started in the survey question. Expectation of rate hikes by other central banks sooner than by the Fed is causing the dollar to weaken. If this indeed turns out to be the correct, will that be bullish or bearish for oil prices? If the Fed is a follower, not a leader, and a weaker dollar, bullish or bearish? We've heard the British or the UK central bank governor be very loud on the impact of inflation. Carol, he's being, saying things in a way that Jay Powell would never do, even though maybe they have similar data points. Inflation triggering a quicker rate cycle. We're only in the US talking about possibly stepping back from buying assets every month, never mind rates 2 years out. Your thoughts on where Europe may go on this issue?
We saw the recently published data on the inflation rates in the EU. So in the UK, definitely that is becoming more of a problem, as the governor or the chief economist of the central bank in the EU and the UK said. But in the EU, I don't remember the numbers quite well. I'm not that good with numbers in the morning. But if you look at the inflation rates, they have been the highest for many years now. And with energy prices making the biggest contribution to the inflation increases that we are seeing in Europe. And this is where I think the link between what we're seeing in terms of economic problems translating or becoming more notable with inflation and what is happening on the energy scene. But just to expand a little bit on that aspect, it's not just about economic problems. It can also create social problems because, again and again, I said it before, energy captures a big chunk of the income of the poorer household. So therefore, any kind of increase in prices, in energy prices, is going to cause some serious economic and social pain. And governments, not only central banks have to step in, but also governments have to step in. And we are seeing some measures adopted.
But of course, a big proportion of that, Carol, a big proportion of that burden is taxation rather than the actual price to the producer, right?
Well, it depends, because you do have a big variation when it comes to taxing, for example, oil products, but definitely in Europe, in the UK. I remember when I was in the UK and I looked at the numbers. If you go to fill your car at the petrol station, you would end up paying more than 70% in taxes. But the good thing about taxes is that they kind of shield the consumer from 100%, let's say, changes in market prices. And here I have to say something, that when you talk about higher taxes in European countries or consuming countries versus what the producers make, like OPEC, because OPEC likes to show this kind of disparity between how much revenues they make and how much European and consuming countries they make from taxes. But there is the issue here of redistribution of wealth, because taxation, you are taking the money from the consumers and putting it back inside the country. But with OPEC, you're taking the money from the consumers and bringing it back to the producers. So we have to go a little bit deeper than just the headline numbers.
But you're still buying your $100 billion redundant F-16s that you never fly, but that's a whole nother conversation. Mike McGlone, on this question, Fed following on the tightening cycle, weaker dollar, ultimately that sort of goes against your narrative, doesn't it? It does support keeping commodities priced in dollars higher.
The key thing to remember about the dollar is it's designed to go up versus a broad basket of currencies. And when people get bearish to dollars, I always like to say, just remember what Churchill said about democracy. It's the same thing. It's a horrible form of government, but the dollar, there's no better. It's the least worst of all of them. So here's the fact. The dollar, trade rated broad dollar, is up 300% in the last 40, 50 years. It's up 30% in the last 10 years. It has the highest yields and the strongest stock market. And the Russian tanks come down from the north. Who are you going to call? So the dollar is going to have a propensity to rally. The key thing people are missing in crypto dollars, the whole market has gone to dollars. So the dollar to me has nothing but strength going for it, unfortunately, and it's had a dip in the trend. And that's just a fact that
But versus the crypto, I mean, speaking of, and give you a chance to talk a little bit about Bitcoin now above 60,000 on a tear, being sort of blessed by the financial system of the US now with ETFs. You know, that the price of Bitcoin tells me the dollar's worthless.
That's the exact opposite in a way, Sean. I'll point out the fact because the most widely traded crypto assets on the planet are now crypto dollars. Tether is just one of them. It trades the same volume as the other 10 cryptos combined, including Bitcoin. So what's happening in this space organically is the whole world's going to dollars for the global reserve currency in a digital way, and it's going to Bitcoin as a store of value. So that's good for the dollar. It's a good sign, and so it means the U.S. is probably going to embrace it, also because it's a pushback in China. So I want to go there a little bit because when I look at all commodities, I see massive elasticity of supply, rapidly advancing technology, increasing that elasticity of supply. Prices go up means that's secure for prices. That's the opposite in things like Bitcoin. There's no elasticity of supply is becoming adopted. So the key thing to remember in cryptos is crypto dollars are the most widely traded assets on the planet. It's happening organically. It means the dollar has been adopted in crypto land. It means the dollar is going to continue to what it has been doing, and there's no replacement for that currency. And then there's stores of value, which is more Bitcoin.
Let's give Bill the last word and get the survey result first to see what the view in the room is. This is bullish. Oh my goodness, what's going on? Bullish prices. We just had we'll all. It is Carol's birthday today, and we will acknowledge that and quietly sing a happy birthday to her from everybody. 21 is a great age, and she wears it well. Bill, you still get the last word, though. Your thoughts on where this goes regionally? Obviously, you're sitting in Abu Dhabi. It strikes me that they have the taste in their mouth for $100 oil again in the region that we saw in the early 2010-15 period. There's a sense that $100 doesn't disrupt the global economic recovery, and they're going for it. Your thoughts from the ground on that?
Yeah, I think that makes sense. They're going to err on the side of higher prices for better or worse longer term.
Yeah, it does feel like that. Let's give Carol a happy birthday. Just raise that glass, blow out those candles.
It's
Carol, come on.
And you know, my husband is naughty.
He is. I do know that. I know that much.
21.
Yes. Well, I there you go. Look at that. Well, I hope he's taking you to Miami for the weekend because I hear it's a lot of fun. We'll wrap it up there. We will be taking a break for the weekend. We're going to celebrate a different thing altogether in the Middle East, which is contrary to a champagne glass, but nonetheless important for the region. So we will time out and be back on Monday morning for the new week of trading. But Mike, thank you so much as always. Bill, great to have you back. And Carol, thank you. Happy birthday to you. And enjoy the day. All the best, everybody. Have a great weekend, and we'll see you Monday morning, 10:30 UAE time.
Thank you. Bye-bye.